Thank you all for joining. Welcome to our clients and friends, and welcome to our guest speaker, Chris. Welcome to the people on the team, my partner, Ken, as well as Barry, Steve, Brittany. I thought Mark was here. I think that's Mark, with Imperial CFOs written there. So thank you all for joining us as well. Thank you again to everyone else. I'm Gershon Margolis. I'm the founder of Imperial Advisory. We are a team of CFOs. We pick up where accounting leaves off, and we help business owners and CFOs sometimes make better, more informed business decisions. We give them the tools, the knowledge, the information and the courage to take big leaps in their businesses and to grow, and, as Andrew said before, take the rocket to the moon. So many of our clients eventually do want to sell. And so some of the education that we do is around sales, exits, mergers and acquisitions. But one of the things that clients, CEOs, business owners often like to do is take care of their people. And that's something that we've covered in prior webinars where we say, if I want to sell the business, but I want my kid to keep their job, what do I do? And the answer is make sure you're not paying your kid to do something that doesn't need to be done. But anyway, another route to how you get your kid to not lose his job is to sell the business to your kid or to all of your employees. So Chris is an expert in ESOPs. He's been doing this for years, and we are very pleased to have him here with us today to talk to us about employee stock ownership plans. And, is the way to get out completely? Is that a way to get out a little bit? How do they work? What do they mean? Without further ado, here is Chris. Please introduce yourself, and then you have the floor.
All right. Well, and thank you, Gershon. It's I appreciate the opportunity to speak in front of this forum. I think what Andrew was talking about. It's actually sort of top of mind for a lot of business owners as they sort of are planning. I actually think this will be, you alluded to it, I think this is going to be a good corollary to your last session with Jeff Berkman and Rob Doyle when they were talking about the human side of M&A. They were talking a lot about taking care of people, like how do you empower the next generation for succession planning, all that kind of stuff. I think this is going to dovetail nicely with that discussion for people if they have to attend both, because an ESOP is an alternative for people. Employee stock ownership plans are a lesser known mechanism for people to exit their business and start their exit strategy. Still less than 1% of all transactions in the space are ESOPs. We feel they're underutilized because they can be a good option. It's not for everybody, but when there's a fit, in terms of what people want to accomplish, it can be a very good, elegant alternative for people, as they look at their exit strategies. So before I get started, and I guess if it's a show of hands or, I guess we won't be able to see the people on the live streaming, but, just sort of curious, how many people have had some exposure to ESOPs? A few. How many people would they say they have a deep understanding of an ESOP? This one. So it's not surprising. There's, it's part of the reason I have a job is helping educate people on ESOPs, what they are and aren't, where they fit and don't, and helping people make an informed decision about what they want to do. So, taking a step back a little bit about us, I work for SES ESOP Strategies. We are a multidisciplinary advisory firm. We provide both the legal and investment banking services to construct ESOPs. It's one of a few firms that actually do that both that hybrid model. We have 7 attorneys, 6 investment bankers. I am one of 3 client development professionals that are involved in sort of educating people on ESOPs and helping them sort of navigate the journey if they want to follow that path or learn more about it. We are part of a broader platform. We're part of Stevens and Lee, which is I'll sort of call it a super regional law firm. It's a 200 attorney firm based in Reading and Philly corridor. We have offices in Princeton. I'm out of the Elmwood Park office in Bergen County, New Jersey, and then New York. But it's where we can work with the attorneys as part of M&A, or we can work independently. There's also a mid-market investment bank, Griffin, which is another affiliate, which we can partner with, again, based on whether it's appropriate for the client needs or not. And then Griffin can also work with a law firm or choose to work independently. But bottom line, we're a sort of a niche advisory firm focused on ESOPs. We did 32 transactions last year. So, it's something that our group is basically created to sort of create the critical mass, because a lot of people don't see ESOPs all that frequently. We focus on it so that when the need is there, we can support people. Again, I have been doing this for a number of years, but before that, I spent 30 years with Accenture. Not a traditional upbringing for doing ESOPs, but my good friend is our CEO, and he and I were talking, and it seems like it could be a good fit because at my core, I'm a business operator. I like to talk to people, help them figure out what it is they're trying to accomplish, and then create a solution that helps them, fit those objectives. And again, ESOPs, it's about education and making sure people understand, what options are available to them as they both look for their exit and also look to take care of their people. All right. I want this to be a discussion. I'll talk, but ultimately, if people have questions, please, chime in, raise your hands. And I'm going to start at a high level and drill down, because I'm guessing that, obviously there's differing levels of understanding. So I'm going to start very high level, drill down, and then, ask questions and chime in if there's anything that needs to be clarified. All right. At its core, an ESOP is a qualified retirement plan. You're selling your business ostensibly to a trust that is a retirement benefit for your employees, akin to a 401k. So it's intentionally not diverse. So a 401k would be diverse. An ESOP is intentionally not by Congress. It's shares in the company that you work for. And again, it's intentional by Congress. What they were trying to do as part of ERISA in the 70s is create broader access to equity for the employee population. So they're trying to bridge the wealth gap. So they felt it was a good thing for business owners to look at ESOPs as an option to exit their business, monetize it in a manner that also helped provide better access to equity for the employee population. In order to incent business owners to use this tool, they created 4 levers that really are sort of trying to incent someone to at least evaluate this option. The first thing is, it's the only benefit plan the government allows you to borrow money to set up. So you can actually take a loan out from a bank on the balance sheet. It gets loaned internally to the trust. The trust then uses those funds to buy the shares from the owner, thus creating the wealth event for the owner, but also setting the table for the benefit plan for the employees. We'll go into that a little bit more, but that's incentive 1, only benefit plan you can borrow money to set up. The next 3 incentives are tax related. You have to do an ESOP as either a C or an S corp. You can convert at the time of the transaction, but when you execute, it has to be one of those entity structures. If you are a C corp, then the owner can defer the capital gains on the sale of that business till stepped up at death. There's rules around it, but bottom line is, in my state of New Jersey and obviously in New York, generally over 30% of the proceeds of a transaction for a low basis business would go to the government. That can be avoided if you're selling your business to an ESOP. Also, as the C Corp.
Question?
Sure.
If you sell to this trust, which is now the employees own that trust, if they ever want to sell their shares, do they then pay those taxes? Or
no? So the employees actually do not own those shares directly. It's beneficial ownership. So what it is the trust actually becomes the owner of the business, of the shares. And then those get allocated out to the participants over time. So it's basically, it's not money that they can, or shares that they can sell directly. It becomes available to them when they retire. So akin to a 401k, when you hit retirement age, you can actually do distributions and it supports your retirement wealth. But yeah, that's a good question. Go ahead.
Thank you. One more, and then I'll stop. Yeah. If you, let's say there's a lot of money in there. Let's say the business does phenomenally well after the owner leaves. That all is locked up until everyone reaches 65.
Well, the people get their money over time. So annually, and this could let me take a step back. I'll get to that. How about I finish through the incentives, and then that'll tie to I'll tie it back. So yeah, if it's a C Corp, you can defer the capital gains till stepped up at death, which is a huge benefit for the selling shareholder in terms of their planning and wealth preservation. If, as a C Corp, the annual contributions to the benefit plan by the company, which are tied to that internal debt repayment, are tax deductible. So that is also cash flow positive for the business. So strong benefit for the selling shareholder, moderate benefit for the business. Conversely, if you do the ESOP as an S Corp, you can actually operate the company as a de facto tax-free entity. Most of you know, as an S Corp, the company has to do distributions to their shareholders for their tax obligations. Well, an S Corp ESOP doesn't pay taxes. So at 100% ESOP, all that is basically free cash flow to the business. So you either get the strong benefit as a C Corp for the owner and a moderate benefit for the business. As an S Corp, you get a tremendous benefit for the business operating as a tax-free entity. The virtuous cycle is, if you can do the transaction as a C Corp, like if you are a C Corp already, or if you're switching to it at the time of the transaction, the next tax year you can convert to S Corp and become a tax-free entity. If you happen to be an S Corp to start and you revoke S Charter, that has nothing to do with ESOPs. It's just the incorporation law that you have to wait 5 tax years before you can switch back. So, but those are sort of the 4 strong incentives that their government has provided ESOPs in order to incent business owners to look at this as a mechanism to bridge the wealth gap. Okay, taking one step down in terms of how it works, and Gershon, this will sort of maybe help start to address your question. Okay, it starts with the company taking a loan out on the balance sheet. Let's call it a mythical $20 million business. No bank is going to loan you full value for a business right off the bat. So in this market, we're seeing maybe 2 turns on EBITDA for lending. So let's say a $20 million business, you're going to get $7 million up front. The selling shareholder will then also do a seller note for the balance of the shares. So that $20 million company, the ESOP gets all 20 million. $7 million goes up front to the selling shareholder. There's a seller note for the remainder, which basically fully funds the ESOP at the start. Now, as I mentioned, there's the external loan to get the money for the shareholder, and then the internal loan that goes to the trust. two separate terms. You're going to do like a 5-year loan for the bank debt. The internal loan is probably about 2025. The reason for that is it's the repayment of that debt that actually triggers the release of the shares to the participants. So you don't want to give out the shares in 5 years. You want it to be an enduring benefit, not just for the current employees, but the future employees. So annually, when the company makes that contribution to the benefit plan to help the trust repay that debt, because the trust really has no assets, the trust will take that money, repay the company the internal loan. So it's just money moving around on a spreadsheet, but it basically creates the tax deduction as a C corp for the company as they then use those funds to service the bank debt in the first 5 years and then ultimately service the seller note. So when the transaction is initiated, the shares go into a suspense account, and it's those payments annually to the benefit plan that actually trigger the release of shares to the participants over time. And so as the participant accounts build up, they'll get statements, look and say, oh, my account's growing. As they get closer to retirement, they can actually, a little bit early, they can opt to diversify, but ultimately it comes down to they will get distributions at their retirement for the shares that, for the proceeds, for the value of their shares. So Gershon, that sort of starts to answer your question. The money basically gets released over time into the participant accounts from the trust. And then when people hit that age of retirement, they will start getting distributions much like they would from their 401k or other pension plans. That makes sense? I'm going to pause there too, because I've just covered a lot, and you sort of went into a little. I went from a high level to get into a little bit of detail there. Any questions, while we, on what I've covered so far?
Yeah, one question, Andrew. Is there for a company that's looking to entertain this mechanism, would you say there's a minimum kind of threshold you want to hit for that company to entertain it?
Well, so the floor for us is generally $1 million in EBITDA and up. And I'm assuming everybody understands EBITDA generally sort of a normalized margin number, but it's $1 million in EBITDA and up, and 25 employees and up. The reason for the $1 million in EBITDA is ultimately you're taking a loan out on the balance sheet at a company level, and you need to be able to cash flow the debt. So you need enough cash flow to be able to basically, service the debt, whether both the bank debt and also the seller note. You can do ESOPs. You can do an ESOP a little bit smaller than that, but chances are it may have to be all seller financed. But generally, $1 million and up is sort of our floor. 25 employees and up is sort of an anti-abuse rule. Again, this is a retirement benefit it's supposed to be a broader based retirement benefit. If you're doing it for 7 people, it sort of looks like a land grab for senior leadership. So it's just sort of, again, these are sort of governed by the Department of Labor and the IRS, given the tax benefits that come into play. So they just provide scrutiny. But, we've done transactions down at that low end of that scale. Our highest transaction to date is $240 million in enterprise value. I would say our wheelhouse is sort of that $15 to $50 million company, but that's sort of the ballpark that we operate in. We sort of focus on the mid-market, but that's where we focus. Barry, you had a question?
How do you create or assess the value of the company if it's a privately held company and those shares trading? Because that's the basis of what they're going to get transferred into the trust. Is that what you do as investment bankers?
So with ESOPs on both sides, both the lending and the valuation, it's generally all about EBITDA and a multiple of EBITDA. At a smaller company, $1 million in EBITDA, you're probably getting a 4x multiple on it at most. You get to 1.5 million in EBITDA, you may get to 5-ish and start going up. Once you approach 2, you can get into, and it depends on industry factors, what type of business, all that kind of stuff. You will get to 6 and maybe 6+. And a trustee is always going to be conservative, so their valuation will probably never cap out higher than a 7x multiple of EBITDA. But that's generally, you start looking at the math, it's multiple of EBITDA for valuation, influenced by customer concentration, industry factors, all that kind of stuff, and then multiple of EBITDA on the lending, how much you get up front, which is generally we're seeing 2x or so in this market.
Thank you.
Very
Any
interesting.
Question? Yep, Ezra.
Okay, first of all, really enjoying the presentation.
Well, thank you.
When we do the like mergers and acquisitions, definitely find that the ESOP, first of all, aside from retaining the employees that are key for the continuation, it also helps with the negotiation process when it comes to pricing, very much so. But my question I have is, well, sometimes the owners feel that they're not sure where the product is and whether, like, is it the type of products that the ESOPs are there like annuities that are attached to it? They don't want to be tied, let's say, to a NASDAQ, or so if the payout is over a 7 to 10 year time period, right? Are there specific products that are more common so that both parties, both the owners and the employees, are satisfied that it's going to hit more than 7-8% returns, or it's just a protective vehicle? Fine.
I'm not sure I fully understand the question. I mean, yes, from an owner standpoint, the payout is going to be over a 10-year period. So you're going to get money up front, bank debt, that'll be a 5-year term. The seller note will be a 10-year term. So up front, the selling shareholder is going to get, again, on that mythical $20 million company, let's say they get $7 million up front from bank lending, and then they're going to do the $13 million seller note at mezz rates on the back end. So the first 5 years, they've got their money, plus they're getting interest on the seller note. And then once the bank debt is paid down, which generally is advantaged by the tax benefits of an ESOP, because you're either getting the deductibility of the C Corp or you're operating as a tax-free entity. But once that bank debt is paid down, then the owner will start getting the balance of the principal on the seller note plus the remaining interest. So over those 10 years, you're getting the money up front, maybe 11-12% on the mezz rates, or ESOPs are very flexible. You can do a lower rate, and maybe this is where some of the things you're thinking about. You can take a lower rate of interest and maybe attach warrants to the seller note.
Exactly, meaning the type of products that we're dealing with, if someone is not comfortable with a mezz rate type of structure, so they want it tied to something more conservative, let's say, or something that's index based or annuity based. How many different financial structures are there out there for an ESOP? There's myriad ways you can structure it. The common model that we see is someone doing, the seller note with warrants attached, because you can, number one, they can be very flexible in terms of some of your estate planning, but it's also very cash flow positive for the business. So the trustee and the bank like
the fact if you're paying mezz rates on the debt, and a lot of business owners are very debt sensitive, you know, that creates a cash drain in the first 5 years of the ESOP, which, you know, is always going to be the tough part. So if you take let's say a 3% interest rate, and then you solve for a slightly higher internal rate of return using the warrants, it's number one, can be a better answer for the selling shareholder, but also better for the company in terms of servicing the debt. One sideline, and if this is getting too technical, excuse me, because there's some people, I know there's different levels of understanding. The one thing, again, super flexible. One of the things that a lot of our clients will do with those warrants, let's say, is if they're covered in terms of their financial planning for their future, you know, the warrants would basically, over the 10 years of the seller note, would grow in value, and you know, at the end you're going to get you know, a payout that'll be treated as capital gains. A lot of our clients will put those maybe in a trust for the kids. At time of execution, they're basically a penny stock. They're not worth much. So you have a, you know, 1 second, Barry, but you have a large company value but the company it's a $20 million company with 20 million in debt. So those warrants aren't worth a lot. After 10 years, when they get cleared, if you have them in a trust for your kids, it can be a very elegant, you know, tax planning mechanism, because they will, you know, pass to your kids and be very tax efficient. So again, that's getting into a detail, but that's yeah. Barry?
Who would issue warrants to whom? You sort of went through that very quickly.
So the seller note for the balance of the 13 million that you know, is remaining after the bank debt, you're going to get a rate of return of mezz rates against that. It's income in the first 5 years for you as a selling shareholder, but it also is a cash drain on the business. You can model it so that you're using warrants against that seller note, and it's basically the trustee. It's a negotiation with the trustee that you can get a certain value back from the company. It's sort of a second bite at the apple, generally around maybe 20-25% of the value of the business, so that when over the 10 years of the seller note, let's say the company grows from 20 million to 35, which is not unreasonable with average growth, those warrants would be worth, you know, $9 million in addition to what you had gotten up front. And so you can either take that money and at the time and pay taxes on it.
A warrant is only valuable when you convert it.
Yeah,
if you're the selling shareholder, why would you really want to get more shares in the business? That's what it would mean what you're doing. Or would they buy back the warrants?
It's synthetic equity. No, you wouldn't want to do it as shares in the business. It's just basically at the end of the 10 years, you would get the cash value of the warrants. It would close at that point.
Okay.
That's generally how the structure we're seeing.
But that's a very good point, I think, because if the end game, if the end strategy after that 5 years, after that front payment or front load, it's really going to be dependent on the performance and the value of the business, let's say in 8 years from now, and the new ownership, the new shareholders blow it by over leveraging, that could come.
Yeah, we want sustainable ESOPs. We don't model them and over leverage them. Generally, you know, for us, ESOPs in many ways are a sustainability play. Yes, it's meant to put money in the pocket of the owner for the business that they built. But the intent of it, and again, this is where the DOL and the IRS come into play. You don't, in our mind, you don't want to push the envelope because you don't want to debt strap the company and have it struggle. The whole point is it should be an enduring benefit, a retirement benefit for the employee population. So for us, you know, sort of like the good fact pattern for a business is, you know, you want someone it's a sort of a caring owner, someone who, is patient. Again, you're taking a loan out on the balance sheet, and you're also doing seller notes. So you're not going to get all your money up front. If you want to be out in 2 years and be done, ESOPs are probably not the answer for you. If you want to push the envelope on last dollar, in our mind, ESOPs are not necessarily the answer for you, because you're potentially, cash trapping the business that you built, and not creating a sustainable solution. So it's, in our mind, patient owner. You don't give up control like you would selling to a third party or PE. The trustee doesn't care how you run the business. They just want to make sure that you've created a legitimate benefit for your employees. So it's an environment of transparency, trust. It's about culture. If it's a good culture, if you have like great place to work initiatives, if you're, educating your employees about your financials and what impact they can have on helping your business grow, those kind of things, are good fact patterns for clients that we see. Want to keep the name on the masthead. You don't want it broken up, moved, sold to a PE that might, merge it into something and take it out of your, your town where it has been a good business for years. So, those are sort of the, some of the things that we see. And I think someone mentioned, Andrew, to your point, they're a great talent attraction and talent retention mechanism. It's, the people are getting a benefit that they don't contribute to it. It's done to them for their benefit by the company. And again, that's what the government is purposely, structured them the way they have to incent that kind of behavior. So, again, I'll pause there to stop. I mean, I can keep talking, or if we want, I don't know if there's questions coming in from the live stream as well, but, happy to answer more questions.
Chris, just a question on the distributions of the share. Thank you for this presentation. Very, very insightful. The distributions of the shares, how does that work? In the sense, I'll just ask it a little bit differently. Obviously, I have top tier salespeople. This is the mechanism for them to buy in, as you will. But we're also a staffing firm where we have potentially between 65 and 100 individuals in the field. And then we have about 10, as you will, back office and or salespeople and recruiters right now. That number, God willing, will grow as well. Is there a way to specifically allow certain employees more buy-in than others?
Well, again, people don't buy into it. It is done by the company for everybody's benefit, and it is non-discriminatory. So it can't be, everybody can participate and does. It's, there's eligibility rules. So typically someone has to be there for a year. They have to be 21 and then work at least half time. Those are sort of typical rules for being eligible. Then if you are, once you become eligible, there's usually, vesting period. So 3 to 5 years. So it may take someone 3 to 5 years before they actually see, actually have the stuff in their accounts, even though it's been pledged to them. Which, depending on, a lot of people have questions about, well, I have a lot of transient, employees. I don't want them to benefit. So you can't discriminate and say they can't participate, but if someone's doesn't last 3 years, they're not gonna really ever see the benefit of it. But allocation happens generally based on total comp. So your more senior, higher compensated employees will get more shares. So someone making 100K a year will get double the shares of someone making 50. So again, depending on your sort of how your compensation structure and key employees are handled, your more senior and more highly compensated valuable resources will get higher allocations. We typically also model in retention and performance SARs, so sort of synthetic equity, or you can use deferred comp as mechanisms to also, make sure you're taking care of your key employees. Because again, you're sort of alluding to it, the ESOP benefit is not a benefit in the now. It's a benefit for their future retirement, but you need these people around in order to sustain the business. And so you do want to make sure that they're, treated properly so that the future growth will come. But because of this incentive, I mean, ESOP companies tend to outperform their peer group. Rutgers has studied ESOPs a lot, and they tend to outperform their peer group because you have getting an additional benefit. People are becoming vested in the business because they behave like owners because they're becoming owners. You have to start with a good foundation. Again, retirement benefit. The government's not going to let you set up an ESOP for a company in distress. Why would they say set up a benefit plan for a company that may be out of business in 7 years? They're going to say no. So you start with a good foundation, you get vested employees, you're getting the tax benefits. So as part of that, ESOP companies generally tend to outperform their peer group, which, has a secondary benefit of increasing their wealth in the now, generally get, increasing compensation. But, it is in the first 5 years of an ESOP, actually the first 2 or 3, people don't always understand the benefit. It's usually like that year 3 when they see their statement and say, wow, I got another material amount in my retirement benefit that I didn't have to do anything to contribute to. So does that answer the question?
It does. I mean, I have 1,000 other, but I'm glad I'm connected to it.
When we're done here, we can always have a conversation after the fact, but yeah.
But thank you. That does help on the surface for me. So thank you. Yes.
I got a question. What happens if you have a 3-year or 5-year vesting period, and let's just say you had 100 employees and the business was worth $100 million? $100 million. So everyone in theory would have had $1 million of that value, maybe, or whatever, 1% of whatever it is. So what happens if 10 people leave? Does whatever is available get reallocated to everyone else, or what happens? And also, what happens when new people come? New people join the business. Do they ever get into this? Do they get what's available from people that left, or?
And that's a big part of planning. There's a lot in that question. So yes, if people either if they don't vest, those shares will come back in and be reallocated. The whole point of having the longer term loan for the internal loan is to make sure that it is an enduring benefit. Generally it's going to be a 20-25 year period that and again, it depends on if it's a higher growth business, you're going to want to make that term that longer because you can make your benefit plan richer than you want it to be. But if future, you want the plan to be beneficial for the few people you haven't hired yet. So there's the longer term loan means that people who get hired later, they'll spend a year there and then start becoming eligible and then start vesting. You do need to think about what happens though as you get into a more mature ESOP. You start getting into years like 7 to 10, you need to plan for something called your repurchase obligations. So that's when people either leave, get fired, whatever, or significant retirement spikes. You have to plan out what happens to those shares. So so like someone who leaves, you say, okay, I don't want them to benefit in my in the benefit plan because they're no longer here. That's not a legitimate incentive. And so typically there will be a repurchase provision in the plan documents that says, okay, we will repurchase your shares and bring them back in-house, but we will do it over the period of 3 to 5 years. Again, you don't want to cash strap the company because that's the whole point is being able to service the debt. So cash flow is king. You also need to look at if you have a retirement spike that is coming, you want to make sure that you're, setting aside the funds that can pay those people out when the time comes. That is where the tax benefits, especially I'm assuming that once you're that far in, you're probably you've shifted to an S corp, even if you took advantage of the capital gains deferral. But if you're not paying if you're not paying income tax, you should be setting aside some of those funds to make sure that you're planning for retirement spikes. And when that time comes, buy back, pay out the shares as people retire. But whether it's people leaving or new people coming in, the whole point is you want it to be sustainable so that everybody can participate, and you're not, you also try and avoid having too many shares in too tightly held hands. So you don't, like early ESOPs, they didn't plan this out as much, and so you had people who retired 20 years ago who still had a good chunk of shares that they couldn't liquidate until they were retired, even if so you have to do that kind of planning.
Can I ask one more point?
Yeah.
Again, I'm really very impressed and very knowledgeable. I mean, I'm enjoying.
Thank you. It's good discussion.
I wanted to ask, as far as the plan documents, do you find that it's common if if the seller or someone who's going to succession, I've had this where, let's say it's a 55-year-old husband, wife wants to stay on for another 7 years or so, right? Do you find that it's common where they could put a restriction on the size of any additional loans on the company, like a sign off that they would have to approve up to a certain amount of proceeds of a loan or a rate? Is that common, or that kind of negates the entire deal?
Talking about like the trustee doing something like that.
Yeah, or a new owner. Let's say a new owner is coming in, right? And
the trustee is now the owner. I mean, if in 100% ESOP, the trustee would now be the owner. They're not going to necessarily, their fiduciary responsibility is to make sure that the benefit plan for the people is legitimate. So they're not going to delve into the company operations and how it's running, as long as there's sort of good governance involved. If they will, they may weigh in if, like you said, okay, new owner. The owner sells and says they want to be around for another 5 to 7 years. So they're going to implement a succession plan that allows that to happen. And you groom the next generation to take on ownership. The trustee probably isn't going to weigh in unless they see like 4.5 years in, you haven't done anything on that. And they say, listen, the future of the business is now sort of being put at risk if you don't implement your succession plan as you discussed. But generally, they leave it up to the governance, and it's really more just good corporate hygiene. If you don't want to overstrap the company, but again, you have a cash flow benefit with tax-free operations, et cetera. So, I'm sorry, Barry.
What percentage of the company is generally sold by the owner to an ESOP?
So we see, I'll call it sort of two barbells, because we see two sort of, and there's everything in between, but in generally, if it's someone who is looking to start their exit and move on to retirement, we'll see 100% transaction many times, because that person, there's a natural delay in getting all your proceeds anyway, and it sort of helps with the grooming of the succession plan. So if you're going to have to wait 7 to 10 years anyway, if you want an exit, there's a natural sort of elongation of the cycle. So again, it can't be someone who wants to be out in 2 years. We also then see people who are younger, maybe have built a good business. Let's say it's someone who's, young 40s, they built a $40 million business. They're like, everything's tied up into it. I'd really like to take some chips off the table. We will see a lot of like 30% transactions, and you can do an ESOP for any percentage. They're very flexible, but 30% is a big number, because if you want to take advantage of that capital gains deferral, the minimum number of shares in the business you have to sell is 30%. So if you want to, go ahead. You had a follow on?
Is it possible to sell a company with an existing ESOP?
Yes. We don't love it because we like to see the ESOP sustain, but we sell ESOP companies all the time. I mean, they outperform their peer group. They are a target for acquisition, even at 100%. But if you've done a 30% ESOP and you've taken, again, $40 million company, you take 30% off the table, so you took 12 million off, you avoid capital gains on it. You have an additional benefit that helps the company grow and retain employees.
What happens
They tend to get targeted for acquisition.
I'm not looking at the seller, I'm looking at the ESOP. If you sell the company, what happens to the ownership within the trust? Are those shares sold?
Well, typically they're bought out by the same in the same process. So the company, I mean, there are ESOP companies that are ESOP holding companies, so they will actually look and then maybe roll it into their existing plan or expand it. But like, let's say, you did a 30%. We actually had there's a company now that we're working with that we did an ESOP for a couple of years ago. They were 50% ESOP and going to head towards 100%. But they got a very attractive offer. I think it might be like 60-70% premium on their shares. And so they're going to sell, and the people in their retirement accounts are going to get a big bump. So if you had, $500,000 worth of shares.
So they'd basically be vested at that point in time based on the value of the shares that were sold?
Anything that's vested in their accounts is basically going to get paid out. So it can be, in terms of a sustainable ESOP, it sort of takes that off the table, which bums us out. But the other mission is, making sure that people are, getting served in terms of their retirement. So, you get someone who gets a, 50-75% premium on their, a good chunk of their retirement account. That's a good thing for their, for their being ready for the next step.
Thank you.
And I mean, it's amazing. You look at, you will have, for mature ESOPs, frontline people with approaching 7-figure retirement accounts, because the ESOPs, again, if you're getting more shares, the company continues to grow, it becomes very much accretive. And so there are people who have retirement accounts that they never would have thought possible prior to having an ESOP implemented at the company. Good questions. I know we're getting close to the top of the hour. Any other quick follow-ons?
All right, let me jump in here and then, well, I guess, Chris, do you have anything you want to say before we wind down?
I would just say anybody, obviously we have a passion for ESOPs and they're sort of an interesting, good mechanism. I would just say the kind of people that I think should be looking at are people who are thinking holistically. If someone is really starting to think about their future, and, because this is sort of an intersection of M&A, tax planning, and employee benefits. And so like, if you're, you can do a lot with ESOPs that, if it, again, depends on what you want to accomplish, but if you're starting to think of, if you have owners who are starting to think about, well, how do I pull money out of the business, or how do I start my plan for retirement? It can be an interesting option as you look at your wealth planning, your tax planning, and your estate planning, because it can play into it in a pretty interesting manner while taking care of your people. So I'll stop there and thank everybody for their time.
Thank you.
Yeah, thank you, Chris. This was very interesting. Thank you all for joining us. I think most of you know us, but if anyone needs a fractional CFO or has anything else they need our help with, you know where to find us. If anyone wants to speak with Chris, Brittany usually sends out the webinars, and then I guess you can send contact info, or if you need it, reach out to Brittany and she will make an intro.
Yeah, reach out to me if anybody wants
Um,
to have a follow-on conversation, so.
All right. Oh, look at that. We have a poll. Thank you, Brittany. Everyone can take a second to answer the poll. That would be great. We appreciate it. All right. Have a great day, everyone.
Thank you.
Thank
Thank you
you.
very much.
Thank you all.
Thank you.
And thank you, Brittany, for getting this all together.
Yes, thank you. And thank you, Gersh.